A friend of mine called me late one evening and asked a question that honestly caught me off guard. He said, "Did Trump just create the biggest investment opportunity of this decade?" At first, I assumed he was talking about politics or the upcoming election, but he wasn't. He was talking about money, serious money. Specifically, a shift that some analysts believe could unlock more than $115 trillion in new investment over the coming years. Now, here's what surprised me. Wall Street didn't seem to panic. Financial television barely mentioned it. Most investors kept scrolling as if nothing important had happened. Yet behind the scenes, something very unusual was beginning to unfold. Companies connected to advanced manufacturing started attracting attention. Defense-related businesses quietly moved higher. Infrastructure firms suddenly appeared in institutional research reports. Three completely different industries started pointing in the same direction at almost the exact same time. That almost never happens by accident. Whenever you see capital flowing into multiple sectors that normally don't move together, it usually means there's a much bigger story developing underneath the headlines. And that's exactly why I decided to spend the last few days digging into the numbers instead of listening to social media opinions. What I found completely changed the way I look at this opportunity. Because this isn't simply about Donald Trump. It isn't just about tariffs. It isn't only about manufacturing. And it definitely isn't another short-term news cycle that disappears next week. This could be the beginning of an entirely new investment wave that affects artificial intelligence, defense technology, robotics, semiconductor manufacturing, energy infrastructure, industrial automation, and even companies that most retail investors have never heard of. But before you get too excited, I need to tell you something that almost nobody talks about. Some of the biggest investment opportunities in history have actually lost ordinary investors' money. That sounds impossible, doesn't it? If a trend is real, shouldn't everyone who buys make money? Not even close. Back in late 2023, I made a video discussing a small group of infrastructure companies long before became the hottest topic on Wall Street. Months later, one viewer emailed me saying he had invested around $10,000 into several of those companies. At one point, his account had grown to more than $47,000. That's an incredible return. But here's the part that most YouTube channels never tell you. A few months later, much of those gains disappeared. The companies were still growing. Their revenues continued improving. The story remained intact. Nothing had fundamentally changed. So what happened? The answer wasn't the business. It was timing. He bought more shares after the headlines convinced everyone else that was the easiest money in the market. Institutions had already been buying months earlier. When retail investors finally rushed in, many professional investors quietly started taking profits. The headlines made people feel early. In reality, they were late. And that's the trap I want you to avoid with this new opportunity. Because if the estimates surrounding this $115 trillion investment cycle are even partially correct, the biggest winners may already be positioning themselves, while the average investor is still trying to understand what's happening. That's exactly what we're going to break down today. We'll look at why analysts believe this market could become enormous, why most investors may still miss it, and most importantly, how to think about opportunities like this without simply chasing headlines. So, let's start with the question that really matters. Why are analysts suddenly talking about a $115 trillion opportunity? The answer has very little to do with a single headline, and everything to do with where capital is expected to flow over the next several years. Whether you support Trump or not isn't the point. Markets don't invest based on emotions, they invest based on policy, incentives, and where money is likely to be spent. And that's exactly why investors are paying such close attention. For decades, the United States relied heavily on global supply chains. Companies manufactured products wherever costs were lowest, imported components from around the world, and focused on efficiency above everything else. That strategy worked for a long time, but over the past few years, several major events exposed how fragile that system had become. Supply chain disruptions, rising geopolitical tensions, semiconductor shortages, and growing competition with China forced policymakers to rethink the country's long-term strategy. Now the conversation has shifted. Instead of asking, where can we build things the cheapest? The question has become, how can America build more of the critical technologies at home? That's a completely different investment story. If factories are built in the United States, they need advanced machinery. Those factories need automation systems, AI-powered software, reliable electricity, data centers, and highly specialized equipment. Every one of those investments creates demand for another industry, and that's how a single policy initiative can expand into hundreds of billions or even trillions of dollars in economic activity over time. This is why many analysts believe the opportunity is much larger than most headlines suggest. It isn't about one company company suddenly becoming successful. It's about an entire ecosystem growing together. When one industry receives massive investment, suppliers benefit, equipment manufacturers benefit, software providers benefit, energy companies benefit, logistics companies benefit. The ripple effect spread much further than most investors realize. History has shown this before. During the early internet boom, many people focused only on the websites they used every day, but some of the biggest long-term winners were the companies providing servers, networking equipment, fiber optic infrastructure, and enterprise software. During the smartphone revolution, consumers noticed Apple and Samsung, while many suppliers quietly generated enormous returns behind the scenes. The same pattern repeated during the cloud computing expansion and again during the AI infrastructure boom. That brings us back to today's opportunity. If this new investment cycle continues to develop, the biggest winners may not be the companies dominating social media headlines. They could be the businesses quietly building infrastructure that makes everything else possible. And that's exactly where most investors make a costly mistake. They assume that because a story is everywhere, they're getting in early. In reality, widespread media attention often arrives only after institutions have already spent months building their positions. By the time the average investor feels confident enough to buy, the easy money may already be gone. That's why understanding the flow of capital matters far more than chasing excitement. The goal isn't simply to know what is happening. The goal is to understand where the money moves first. Because once you understand that sequence, you stop reacting to headlines and you start thinking the way professional investors do. And that leads to the biggest mistake almost everyone makes with trillion-dollar investment themes. Before we talk about the 3 waves of companies that could benefit the most, there's one investing trap you absolutely need to avoid, because ignoring it has cost investors billions of dollars over the past decade. And before we go any further, if you're the kind of investor who wants to stay ahead of major market trends instead of reacting after everyone else, make sure you hit the subscribe button. I upload in-depth market analysis every single week, and if you find this video valuable, don't forget to leave a like. It really helps the channel and tells YouTube to share this video with more investors like you. Now, let's get back to the opportunity. Before we get into the 3 waves of companies that could benefit, we need to talk about the biggest investing trap of all. It's the same mistake that repeats itself in almost every major market trend, whether it's the internet boom, electric vehicles, AI, or now this potential $115 trillion investment cycle. Most people believe that if they correctly identify a major trend, they'll automatically make money. Unfortunately, that's not how the market works. Remember the investor I mentioned earlier, the one whose $10,000 investment grew to more than $47,000? Most people hear that part of the story and think, I wish I had found those stocks sooner. But that's not the lesson. The real lesson is what happened next. As excitement around AI exploded, he became even more confident. Every news channel was talking about artificial intelligence. Financial influencers were calling it the opportunity of a lifetime. Analysts kept raising price targets, and retail investors rushed into the same names. Then something unexpected happened. The companies themselves continued reporting strong earnings. Revenue kept growing. Demand remained healthy. Nothing was fundamentally wrong with the businesses. Yet many of those stocks experienced sharp pullbacks, wiping out a large portion of earlier gains. Why? Because the professionals weren't buying the headlines, they were selling into them. Institutions had already accumulated their positions months before the average investor became excited. When millions of retail investors finally entered the market, professional money managers used that surge in demand as an opportunity to lock in profits. The story was still true, but the timing had changed. That's one of the hardest lessons in investing. A great company doesn't always make a great investment at every price, and a powerful trend doesn't guarantee profits if you enter too late. That's why I always tell people to remember one simple rule. Headlines usually confirm what smart money already knows. When you see a trend dominating every news outlet, ask yourself one question: who was buying before everyone started talking about it? That's often where the real opportunity begins. Now, if you're wondering how to identify those opportunities before they become obvious, that's exactly what we're covering in our free live webinar next week. I'll walk through the framework I use to track capital flows, identify emerging themes, and avoid chasing stocks after the excitement has already peaked. There won't be a replay because we'll also be discussing current market data that can change quickly. So if you want to attend, you'll need to register using the link below. Now let's move on to the part you've probably been waiting for. If this investment cycle continues to unfold, I believe the opportunity can be divided into 3 different waves. Understanding these waves could help you think beyond the obvious names that everyone else is watching, and that's where the most interesting opportunities often appear. Let's start with what I call the first wave, the builders. These are the companies responsible responsible for creating the physical foundation of this entire investment cycle. Whenever governments or large corporations announce hundreds of billions of dollars in new spending, that money doesn't magically appear in finished products overnight. It starts with construction, equipment, factories, industrial automation, power systems, and semiconductor manufacturing facilities. Before advanced A can run, before new defense technologies can be deployed, and before American manufacturing expands, someone has to build the infrastructure that makes it all possible. That's why many institutional investors often pay close attention to companies involved in industrial automation, factory equipment, electrical infrastructure, engineering services, and semiconductor manufacturing tools. These businesses rarely dominate the headlines, but they frequently benefit long before the public realizes what's happening. The exciting consumer story usually comes later. The infrastructure story comes first. The second wave is what I call the brains. Once the physical infrastructure is in place, the next stage is intelligence. This includes computing, advanced networking, cloud infrastructure, cybersecurity, high-performance memory, and the enormous data centers required to power modern artificial intelligence. Everyone talks about software, but software is only one piece of the puzzle. Behind every A application sits an enormous amount of expensive hardware, specialized chips, networking equipment, cooling technology, and electricity. Without that foundation, even the most advanced A models can't operate efficiently. That's one reason analysts continue watching companies that supply the technology powering this digital infrastructure. As demand for artificial intelligence grows, the need for computing power, storage, and reliable energy grows alongside it. The companies enabling that expansion may continue benefiting long after the initial excitement around headlines fades. The third wave may be the least understood, but it could also become one of the most important. I call it the shield. This includes companies involved in advanced defense technology, autonomous systems, satellite communications, electronic warfare, cybersecurity, and next-generation military software. Modern defense is changing rapidly. Governments are investing not only in traditional military equipment, but also in artificial intelligence, autonomous drones, secure communication networks, and technologies designed to improve decision-making on the battlefield. What's interesting is that many of the companies supporting these systems aren't household names. Some build sensors. Others develop specialized software, communication hardware, electronic components, or mission-critical technologies that larger defense contractors rely on. These businesses may never receive the same media attention as the industry's biggest players, but they can still become important pieces of a much larger investment trend. Now, does this mean every company connected to these three waves will become a winner? Absolutely not. Every investment carries risk, and markets can move in unexpected ways. That's exactly why understanding the theme is only the first step. The real challenge is separating companies with durable competitive advantages from those simply benefiting from temporary excitement. And that's where most investors need a framework instead of hype, because once you understand how these three waves connect to each other, you're no longer chasing random headlines, you begin following the actual flow of capital. In the final part of this video, I'll show you the simple three-step framework I personally use to evaluate opportunities like this, and why having an exit strategy can be just as important as knowing when to buy.